If you look at things like the home price to income ratio, it's never been higher. And you throw in taxes and insurance, home prices are unaffordable. That's why it really bothers me when I heard some economists, there was one on Bloomberg, well, inflation's back in the bottle. The genie's back in the bottle. Inflation is quiescent. The battle with inflation has been vanquished. And what bothers me about that more than anything is they're not looking at the salient issue. The salient issue is that the level of prices has bankrupted most of the middle class. The bottom 4 quintiles of the middle class have been destroyed by the level of inflation. The fact that it dropped from 9% at a rate of change basis to 3.2 on the core, year over year core, is not indicative of quiescence and panacea for the middle class. It just means that inflation has come down, but it's rising faster than the Fed's target. So this person who was on Bloomberg was saying there are anecdotal stories, anecdotal evidence, and he presented like his niece was eating ramen noodles in the grocery store, and that's high for her, and she's saying, well, inflation's still high. But this is a 1%er problem. Now, I'm one of the 1%. I used to be in the middle class for a good part of my life. Their living standard, their purchasing power has been destroyed. And the fact that the Fed wants to pursue a higher rate of inflation that we have already, even though the level has destroyed the middle class and prices are rising at 3.2% on the core, that's not good enough. And that's why when people use metrics like the consumer's debt to income ratio is quiescent, and they say the interest expenses on their debt is quiescent. So you look at household debt as a percentage of income, it came down from like almost 100% in 2007 to it's like 79. Now 79% is still very high, but what you're not taking into consideration is that the consumer has already been wiped out due to inflation. They cannot afford cars. They cannot afford insurance. They can't pay their taxes. So their cash flow situation has been eviscerated. And then you add on to that a historically very high debt service cost, not as high as it was in 2007, but historically high compared to the 60s, 70s, 80s, and 90s, still very high. And you have a very stressed consumer. You see concurrently asset bubbles in homes, real estate market, total market cap to GDP, all-time record high. It's only 200%. In 2007, it was 104% to GDP. It's much higher than it was in 2001. The NASDAQ bubble burst. It's higher than it was in 1929. Much higher. And of course, that's not the only metric I look at. If you look at price to sales, it's through the roof. Historically, right. Through the roof, price to sales on the S&P 500. And you look at the CAPE ratio. We have the bubble in equities is undeniable. It's trading at 21 times next year's earnings, which is incorporated a 15% earnings growth rate. How are you going to get 15% earnings growth when we have a large part of the Trump's tax cuts going to sunset at the end of 2025? People know that it's going to happen unless you have a sweep, a Democratic sweep or a Republican sweep. There are very low odds of that happening. So you're not going to get 15 earnings per share growth of 15%. And you're not going to get 21 times that, but you're getting that now. It's already priced in. In a nominal GDP world of 4 or 5%, you're not going to get 15% earnings growth when you have higher taxes on those earnings. Corporate tax rates are going higher at the end of next year. And then you have the credit bubble. You hit on it. If you look at corporate debt to GDP, record high. And there's also the shadow banking system. So you're talking about hedge funds and pension funds outside the banking system. They've gone bonkers issuing debt. If you look at inside the banking system, collateralized loan obligations, CLOs, through the roof. Private credit, something that we never even heard of before, leading into the financial crisis. It's $1.7 trillion. And what is private credit? It's like, you're a business, you can't get a loan. Small business, you can't get a loan from the bank, you can't issue debt, so you go to the shadow banking system, they give you money. And this is a leveraged corporation, a leveraged business. It's a very, very risky loan. And there's now almost a couple of $1 trillion of that kind of debt out there when there used to be nothing with no regulation. So we have 3 bubbles existing concurrently. And there's a very good reason to believe that even though the Fed cut 50 basis points, that does not equal a panacea. The banking system is clinging on to their assets of mortgage-backed securities, commercial mortgage-backed securities, CLOs. So, if you have a recession, and I don't think that 50 basis points of a reduction in the overnight interbank lending rate is going to preclude the business cycle from ever happening again. In fact, if you look at past Fed rate cuts of 50 basis points, let's just look at the last 3 times that happened. So the Fed cut basically to zero starting in February of 2020, almost to zero right away when the outbreak of COVID. Well, that didn't stop the S&P 500 from dropping by 35%. in a matter of weeks. Okay, well, Mr. Pento, that's COVID. It's a bad example. Okay, we'll go to 2007. The Fed cut interest rates in the summer of 2007 by 50 basis points. In the ensuing 2 years, the S&P 500 dropped by 50% and home prices dropped by 33%. That was a once-in-a-lifetime credit bubble, housing bubble, so that is a bad example, Mr. Pento. Let's see. Okay, let's try this. Let's try 2001, when the Fed cut interest rates in the summer of 2001. They cut by 50 basis points, and 2 years later, the S&P dropped by 50% and the NASDAQ dropped by 80%. So it's not a panacea. You have a lot of debt, a record amount of debt caused by 22 years of negative real Fed funds rate. That's unprecedented in history. That's why you have these asset bubbles. The real Fed funds rate was minus 8% not too long ago, a few years ago. So if you look at the 20 years prior to that, you go back 40 years, we had a real positive Fed funds rate. But then we entered the fantasy island world of massive interest rate repression. When money's free, what do? You borrow it. Money was virtually free. In real terms, it was free. I could borrow money at close to 0%, and I could buy anything on earth, like, gold or commodities or stocks or real estate, and make 8%, 9%, because that's what the inflation rate is. And when you borrow a lot of money, guess what? You get asset bubbles and you get a tremendous amount of debt. And that's what we're left with. And 22 years of that. And no one can convince me in the world. I don't know if you say, well, there's really not a housing bubble. Well, it's really not a stock bubble. You could say that if you want to, but you're telling me that 22 years of free money didn't cause asset bubbles? I gave you all the facts if you don't believe it. Those are the facts. And there's a lot of cross-pollination there between the shadow banking system and the commercial bank lending system. They are all saturated in debt. And if you have a recession and the business cycle hasn't been repealed, there's going to be hell to pay. The natural force of things, gravitational forces of deflation, are extremely prevalent. It's like a black hole. So in other words, you have to have a lot of artificial stimuli. And by that, I mean monetary infusions, monetary injections to stop the gravitational forces from taking hold. So for instance, home prices need to drop by 40% to put them a reversion to the mean, not below that, just to revert to the mean. Home prices have to drop by 40%. Now, what would happen to the banking system if the value of mortgage-backed securities dropped by 40%? I'm talking about the shadow banking system and the commercial banking system. They would be wiped out. There wouldn't be a solvent pension plan or a solvent hedge fund on the planet, practically. So that is where they should go. And coincidentally, maybe not so much, stock prices need to drop by 40%, or closer to 45% now, just to bring them back to 100% of GDP. Assuming GDP doesn't drop, if home prices and stock prices don't drop, and the credit bubble doesn't, and that's a bad assumption. So you're looking at a massive wipeout of the top 20% of that cohort of consumers who have been keeping the whole economy going. Buying houses for cash in Naples, Florida, where I live. That's the cohort that's keeping the economy going. Buying Bentleys for cash. I read a statistic that, for example, about a year ago, 68% of all home purchases were purchased by investors. Investors own in aggregate about 25%. You have a portfolio. If you're a corporation on Wall Street and you own a profile of thousands of homes, or even if you're an average Joe or above average Joe with 5 houses in your portfolio, and you've got a huge gain of 100% or so in those houses, and you can't rent them out anymore because people are losing their job and the cash flow dries up, and you say, I'm going to put 4 houses. I can't live in 5. Don't live in 1 at a time. I'm going to put 4 houses on the market. That's what's going to happen in droves, and home prices could crash. And home prices crash, your net worth disappears for especially the top 20%. So you could have a severe natural course of things is to have the gravitational forces of deflation reset all of these imbalances in the economy. There's no way Jerome Powell, I don't care what you think he is, conservative, Democrat, free money guy, or hard money guy. He dropped interest rates pre-COVID pretty substantially. So 2019, he was cutting interest rates before the virus was even known. And he kept buying mortgage-backed securities in 2022, in early 2022, after the COVID was a problem and home prices were through the roof. And he's the one who reduced interest rates in emergency measure by 50 basis points last week. Even though inflation, headline 2.5%, core 3.2%, is way above target, even though the unemployment rate is 4.2% when historically it's 5.7%. Even though we have massive asset bubbles, credit spreads are tight, financial conditions easy, why is he cutting by emergency fee? I mean, this gentleman has proven through inculcation to Wall Street and me that he is there. So my point is that the Fed is not going to go quietly into the good night and just let the deflation fix everything. He's not going to do it. He's going to cut rates to zero, and he's going to go back into ZERP, and he's going to join hands with Janet Yellen and have some kind of monetization of helicopter money if they can get it through Congress. That's what's going to happen. Every other time they've done that, it's been successful in reflating asset prices because the Fed has been able to take down short-term interest rates. They control money markets. They can do that. They absolutely can control the interbank lending rate, but they don't control directly long-term interest rates. That's a function of credit quality of the United States government and inflation. And every other time in the past, they've managed to successfully bring down both short-term and long-term rates. What if this time, precisely because we have $1 trillion in interest payments on the debt, precisely because we have not vanquished inflation and we're starting going down the dangerous path of trying to reflate the economy when we haven't fixed the level of prices by any means whatsoever? What if interest rates on the long end rise? And that's what I think is not only possible, but probable. If that's the case, you don't fix anything because long-term interest rates are what mortgages are based off. And if you have a spike in long-term interest rates, it's going to be detrimental to the stock market too. So in other words, I'm saying there might not be anything the Fed can really do. Have you noticed that since the Fed cut interest rates by 50 basis points, the long end of the bond market, the yield has gone up and prices have gone down?